For decades, one defining feature of the global financial landscape has been China's significant ownership of U.S. government debt. Many are aware that China not only held this debt, but was once the largest foreign holder, surpassing even some of America's closest allies. However, by early 2024, this position shifted. Japan now holds the largest share of U.S. securities among foreign investors, with over $1.1 trillion. Previously, China led, but its holdings of U.S. debt have significantly declined. If this trend continues, China could become one of the smallest major holders of U.S. debt in the future. The question is, what would happen if this scenario becomes reality? Would it disrupt global economic stability, or would other investors quickly fill the gap? What is U.S. government debt? To understand this issue, it's important to know what U.S. government debt entails. When people refer to U.S. government debt, they mean securities issued by the U.S. Treasury Department to finance the nation's obligations. These securities include short-term Treasury bills, medium-term Treasury notes, and long-term Treasury bonds, collectively known as Treasuries. According to the latest data from the U.S. Treasury Department, total federal debt has surged to over $35.4 trillion in the third quarter of 2024. China holds about $700 billion of this debt, alongside Japan, other foreign nations, pension funds, central banks, and domestic investors. Why do countries still buy U.S. bonds? Why do countries and investors continue to purchase U.S. Treasuries? First, U.S. Treasuries are considered to have minimal default risk, making them one of the safest investment options. Second, the U.S. Treasury market is large and highly liquid, allowing buyers to easily enter and exit positions. This means if China wanted to sell billions in bonds overnight, it could do so because there are plenty of investors ready to buy. Third, the U.S. dollar is the world's primary reserve currency, and many central banks hold most of their foreign exchange reserves in dollar-denominated assets. In other words, China acquires U.S. treasuries for both economic and strategic reasons. How did China become the largest holder of U.S. debt? China became one of the largest holders of U.S. treasuries due to massive accumulation since the early 2000s. During this period, China's economy grew rapidly, attracting global investment from the U.S., Europe, and East Asia. As a major producer and exporter of global goods, China amassed vast amounts of foreign currency, particularly U.S. dollars. Since China's exports far exceeded its imports, it accumulated unprecedented dollar reserves. However, China couldn't simply hold these dollars in banks. It needed to invest them, and U.S. treasuries were a logical choice due to their safety and liquidity. Historical trends and numbers. In 2000, Japan held over $307 billion in U.S. securities, while China held only about $70 billion. By 2008, China surpassed Japan, with its holdings rising to over $700 billion. At its peak in 2013, China's holdings exceeded $1.3 trillion. However, since then, the trend has reversed. By October 2024, China's holdings had dropped to approximately $760 billion. Why is China selling U.S. bonds? Several factors explain this decline. 1. Belt and Road Initiative, BRI. China has used part of its foreign exchange reserves to fund this ambitious project, connecting Asia, Europe, and Africa through infrastructure networks. In 2018 alone, investments exceeded $50 billion. Second, BRICS. As a member of BRICS, Brazil, Russia, India, China, South Africa, China is reducing its reliance on U.S. treasuries to diversify its reserves, promote local currency use, and build alternative financial systems to the IMF and World Bank. 3. Increased gold reserves. Data shows that as China's treasury holdings decline, its gold reserves have increased. This is a strategic move to shield itself from external pressures like sanctions and geopolitical tensions. What happens if China stops buying U.S. bonds? If China halts purchases or begins selling its holdings on a large scale, several serious consequences could arise. Rising treasury yields. Lower demand would drive bond prices down, increasing yields. Higher borrowing costs for the U.S. Increased yields would raise the cost of borrowing for the U.S. government. Weaker U.S. dollar. If China reduces its dollar reserves, the dollar's value could weaken. Rising import prices. A weaker dollar could increase the cost of imported goods, potentially triggering inflation. Market confidence shaken. This could lead to short-term global instability. However, the U.S. Treasury market is vast and deep, with daily trading volumes exceeding $500 billion. Other investors could likely absorb the shortfall, though short-term disruptions might still occur. In recent years, the China-U.S. economic relationship has been a focal point globally. China, once a major supporter of U.S. bonds, is now gradually retreating. This isn't just about numbers, but also about long-term strategy and shifts in the global order. If this trend continues, the question remains, what will happen if China truly stops buying U.S. debt? Share your thoughts in the comments below. Don't forget to like, subscribe, and turn on notifications for the latest updates on global geopolitics, economics, and the evolving world order. Thank you for watching, and see you in the next video.